What is break-even analysis for small business planning? Have you ever wondered how small businesses figure out when they will start making money? That's where break-even analysis comes in. This financial tool helps business owners understand the exact point at which their total revenues equal their total costs. At this point, the business is neither making a profit nor incurring a loss, which is known as the break-even point. So, how does this work in practice? First, break-even analysis identifies the minimum sales volume or revenue needed to avoid losing money. This gives small business owners a clear target for their operations. It also helps in setting pricing strategies. By examining how changes in sales price or costs affect the break-even point, owners can make informed decisions on pricing their products or services. When planning to launch new products or expand offerings, break-even analysis is essential. It reveals whether the expected sales will cover the associated costs. This is particularly important when considering investments, as it helps determine if outside funding or adjustments to costs are necessary before profits can be realized. Now let's break down the key components involved in this analysis. First, we have fixed costs. These are expenses that do not change with production levels, such as rent, salaries, and insurance. Next, we have variable costs, which vary directly with production volume, like raw materials or direct labor. The sales price per unit is how much you charge customers for each product or service. Then, we have the contribution margin. This is the difference between the sales price per unit and the variable cost per unit. It shows how much each unit sold contributes toward covering fixed costs and generating profit. To calculate the break-even point in units, you can use a simple formula. Break-even point in units equals fixed costs divided by the difference between the sales price per unit and the variable cost per unit. For example, if a small business has fixed costs of $10,000 per month, sells a product for $20, and has a variable cost of $8 per unit, the break-even point would be 10,000 divided by the difference of 20 and. This equals 833 units. This means the business needs to sell about 834 units each month to cover all costs. Alternatively, you can calculate the break-even point in terms of sales revenue using the contribution margin ratio. This helps you understand the dollar amount of sales needed to break even. For small businesses, conducting a break-even analysis is a key part of financial planning and analysis. It allows entrepreneurs to evaluate the feasibility of their ideas, set realistic sales goals, and manage costs effectively. Even after a business is up and running, revisiting this analysis regularly can inform decisions about pricing changes, cost control, and growth strategies to maintain profitability.